All right. Hello, everyone. Hello. So we're going to kind of talk a little bit about what's going on the economic level, both on a national, state, and a local level, and kind of look at projecting what's going to go forward for 2018. Try to give you a little bit of an idea of things you can, talking points and information you can use with buyers or sellers or relocation. Certainly also maybe to help you do some planning for your own business. So that's kind of the focus of everything we're going to look at. On the national trends, kind of broke it up in a few areas. For jobs, it's been a remarkable year this last year, 2016, 17, and now even going into this year as far as number of jobs created on a national level and where our unemployment rate is. So we're going to look at that. It's actually getting close to being a point where you could say we had full employment on a national level. We certainly have full employment on a local level, and that creates a whole. That's a good thing. It's better than the alternative, but it also presents some challenges for employers, is trying to find employees and retain them. Home prices, you have a lack of inventory on a nationwide level. We're going to look at that a little bit. Home building, basically same issue. They could build. They could sell everything they could build. Consumer confidence is at a 17-year high. It's almost at an all-time high. And it's over a very long stretch of building and improving. Stock market, good heavens, what can I say about that? Population growth, unless immigration slows, then you're going to see continued population growth on a nationwide level, and that presents some big challenges as far as providing the full need for housing. This gives you an idea of what the job growth has been. This is a very 18-year period of time where we've averaged almost 200,000 jobs a month of creating new jobs in this country. During that same period of time, with that long stretch, you've seen unemployment rate go down. It's almost down to the point of one of the very lowest it's been in a very long time. It was a little lower back here right before the tech bust. And you've got to go all the way back to the Vietnam War before you find unemployment at the same level that it's at. It's kind of remarkable to look at what that is. So unemployment levels are a little different right now than what they were in the past, because there is some structural changes. More people have a part-time job who want a full-time job. So there are some issues there. But at the end of the day, they still have a job. And that's been a remarkable change from the recession all the way down to where we are here. And I kind of listed also kind of where we are with other states. Here's where the United States is. Here's where Texas is. U6 is the what sometimes people call the real unemployment. That includes discouraged workers, people that are part-time that want full-time employment. And it has steadily plummeted. On a national level, that number's at 8.5%, and that would probably normally be about another percent lower than that in the past when you had unemployment down to this level. But these are truly historically low unemployment levels. One of the big issues is tech workers, and you hear a lot about whether it's Amazon or it's Apple or whoever it is that's looking to relocate and looking to hire. You hear a lot of conversation about tech workers, and it's kind of hard to, almost sobering to realize you're talking about out of 160 million labor force, the definition of a tech worker being like a software developer or IT infrastructure, something along those lines. That's only 7 million workers out of that entire workforce. So you're talking about 4% of the workforce is actually driving most of the decisions about where companies relocate and how they expand their businesses. We're going to come back to that shortly when we kind of look at where Austin is and Texas is as far as the number of tech workers that we have. Home prices on a national level, you see what Austin increased this last year. It was down from its typical 7%, 6 or 7% median price. Nationally, year over year, home prices across the nation have increased 7%, and that was driven by a handful of states which have had really white hot increase. This is really hard on a market when you're having 10 and 12%. That's great if you happen to buy a house and you sell it, but for everyone trying to find homes for buyers, it makes it really a very big challenge. So,
is that a correction from the bust, maybe from where it went?
Well, they haven't been at, so the question is this kind of still correcting for the bust? And some of these markets weren't as hot as Austin was for this whole like 8-9 year period of time. But no, some of them have been increasing for quite a while, so much so that in Seattle, what the median price is, I'll come back to this several times. You want to guess what the median price is for a home in Seattle now is, for the city of Seattle? 900 is a little too high, 750,000. What a very difficult environment to be in for trying to find houses for home buyers. So it's been increasing quite a bit over there. A lot of that is driven by what reason in Seattle? Amazon. They have driven up the cost. Their white hot growth that they've had has really helped drive up that cost.
You said that was the average price?
That's the median price.
If one of Amazon chose to come to Austin, how do you feel about that?
We're going to get to that in just a minute.
Oh, okay.
We're on the national level. We're going to get down to Austin level in just a minute. I got asked that question 2 or 3 times, so I just put a whole section in here about Amazon. So we'll just get it over with. This is really kind of the same thing that mirrors on a state level and on a local level. This is talking about the national level and households that are created. So these bars are the population growth. This is how many people added each year. The lines are cumulative, are lines for single family, for multifamily, and you add those two together and you get your total number of households created. So as you have population growth, you've got to create homes for them. You've got to create some place for people to live. So here's what happened on a national level. This is back in the 80s. We had a big apartment boom. So that ran the number of households created up. And it was more than what we really needed. So you had a bit of a drop and a bit of a bust in home building and household creation in the early, in the 90s. Yet notice what our population did. Our population kept growing. And that growth right there in the population drove all of this household creation for this long stretch of time from the early 90s all the way up to the Great Recession. Notice one of the things that happened in the Great Recession was that we had a lot of lax lending requirements. So we were able to provide home equity loans, subprime loans, and homes for buyers at the same time that the population was slowing down, population growth was slowing down a little bit. So you wound up creating pretty much an overbuilding in the nation. So you had a bubble that did pop, and that was right here. So over this next 12 years that we saw our home building on a national level and on a state level and on a local level really crash down, yet our population did not slow down. We still continued to build construction. I would love a deal of water, a water if you could get one. So during all that population growth, you've seen us really struggle trying to create enough homes. So you've seen an inventory shortage. You've seen price increases across the board in almost every market, no matter how slow or how hot those markets were. You're still dealing with a supply and a demand issue. And so on a national level, you've seen prices increase. A lot of that supply and demand, if not the majority of it. And you notice that on a national level, and this is also true on a local and a state level, it's been really hard to maintain the growth of apartments. They've built a lot of apartments. You've seen a lot of apartments built in the city. We've seen the same thing in Austin, where we came out of it and we started trying to make up for the shortage of single family by building multifamily, and it's been very hard to sustain for all kinds of reasons. A lot of it is on trying to build enough, have enough capital to do all that kind of construction for multifamily. Some of it is land, some of it is entitlements, and that has created a consistent challenge across the board for us to create enough of the multifamily. Here's where our normal household creation, this is kind of taking the 2000 through 2003 level of home construction right in here and kind of extend that across so you see how much we're missing in new home creation or multifamily creation, condo, townhome, teepees, something for people to live in. And you've had quite a challenge. And we're not really fixing this issue. This has turned into a structural, systemic problem across the nation. During that same period of time, because of job growth and because of other issues and in the economy, you've seen a really dramatic increase in consumer confidence. You see the big drop we had during the tech bust, the great drop you had during the Great Recession. And I would actually say that this right here, which was higher consumer confidence, most of this was artificial. This was being created by some factors that were probably not very supportable. I think there's nothing artificial about this consumer confidence that's been built over this stretch of time over this 18-year period of time that we've had. So I think that will continue to increase this year. You saw during the election a lot of conversations about GDP growth, gross domestic product, a lot of conversation that our country needed to grow at a faster pace. We, in our country, solved most of our ills for balancing our budget and finding jobs by having our economy grow. If the economy doesn't grow at a 3%, or a lot of times we in the past were able to grow at 4% rate, then we struggle a lot. So a lot of the debate in the elections was about what can we do to get our economy so we can get back up to like a 4% growth rate. Well, you look at I put this up here so you can just see what we're really dealing with. A lot of developing economies have trouble maintaining a 4 or 5% growth GDP growth rate. We have been there in the past. We've been a pretty high growth rate in the past. But over time, our trend line, this is the trend line that's going on. So if I took that and I extended it way on out here, it would look like this. I changed the scale on this so it's a little easier to see. This is the same trend line. Here we are right here, around 2.4. I think it's last year, so 2017, we're at 2.3% GDP growth rate. The year before that, we're at 1.5. The trend line for all this, as you extend this on out, eventually we get down to where we have a zero growth rate. So there's a big debate going on now within a lot of reasons, whether you're for or against tax cuts or you're for or against having trade deals. A lot of these issues are really bound up in what is it going to take to get this to flatten out so we at least can maintain a certain level. You see we're all over the board for this next year. Wells Fargo's at 3% growth rate, all the way down to the World Bank is down to 2.1. A lot of observations as to what's going to be going on with the tax cuts. Is that going to help stimulate enough growth? And will it only be for a 1 or 2 year period of time? And will that be a sustained growth? Again, a lot of our issues are bound up in whether we can get that growth rate up. Mortgage rates, it's going to be a big issue this year. What are your mortgage interest rates going to be? This is just kind of looking at since 2010. So over the last 8-year period of time, you see that we've been up around 5%. We were in 2013, we're at 4.5%. This time last year, we were higher than we are right now. We were at 4.3% in March of last year. You see, we've started increasing our interest rate. A lot of conversations at this time, we're really going to go to 4.5 to 5 or even 5.5% mortgage interest rate. Here's what our since 1994, if you average it out, we're at 6.29%. So basically, I'd tell you, 3.5 to 4.5% is not normal. That has been a suppressed interest rate because the federal government was buying up all the mortgage loans because of some other growth issues and concerns about it. That interest rate has been held down artificially low. This is not a realistic interest rate, particularly when you look back at this. Just for a fun fact, here's when I went to work. It was right there, right exactly on that little dot right there. It was when I first started my career in 1981. I did loans at 18%. So closed loans at 18%. And we closed lots of loans then, amazingly enough. It was a little stressful, but it was. We did close them. I think a more realistic is going to be 4.5 to 5.5% is going to be more projection. NAR is projecting 5% by the end of this year. MBA is projecting 4.5%. So I think it's probably finally here. It's kind of like a stop clock is right twice a day. All the economists have been predicting that we're going to have interest rates are going to finally increase. And I've heard that now through all of this whole period. Actually, this whole period of time, interest rates are going to start going back up. I think they might finally be right now. So 1% increase in interest rates results in 11% drop in purchasing power. So if you've got someone qualified, they can pay around $1,600. If interest rates are $450, they can afford a $395,000 house for PI, principal interest. If they go up to 5.5, then that drops down by about $40,000. So those are some things to have in mind as you see the interest rate grow up. There is a direct impact on buyers and their purchasing power and what they can get qualified for. A little difficult to see that happening right when home prices continue to go up, but these are going to be some things that you may get to deal with this year. Let's look at Texas for a little bit. Really good leading indicators. This is from the Federal Reserve of Dallas, talking about leading indicators. They've got an index that really looks at job postings and a whole number of issues, and gives you a good idea of what's going to be for this next year, how much this has increased for this. So this is kind of what's projected for job growth in Texas, probably about 300,000 jobs. Very solid year. Probably the only wild card for that is going to be price of oil. If price of oil continues to stabilize or even possibly increase, which it looks like it may, because of the things that have held down on production in the world, consumption is going up, continues to go up gradually. Really good reason to believe that the oil prices will hold steady. Natural gas demand will be very high. So I would say very positive things for the Texas economy. Most of all of the big dip and the other variations in here, that was the recession. These other variations have been because of the price of oil. This is all because of the price of oil. Just looking at what unemployment rates have done have been staggering. So there's Texas, there's Austin, there's Texas, there's the USA. So you see that the USA has just consistently come down. We're now down to 4%, like we said. You see what the drop has been of Texas over this last 2 years. And Austin is at a ridiculous 2.6%, 2.7% unemployment rate. That is actually scary. That's an unhealthy unemployment rate. That is an unemployment rate that says to any company relocating here, why would you relocate here? There's no one to hire. You know, you're going to have to be hiring everyone, stealing everyone from Apple and Facebook, and that's fun. So that would be that's a scary proposition to see us down here. I'd be very happy to see unemployment rate to go back up to 3.5% or even 4%. That's fine. You'll see great big headlines that, you know, we're in a lot of trouble. It's like, no, we're not. We're actually building a labor pool that would attract employers here. And if it stays down like this, it's going to be a real challenge. You would think that's an indication of different, just kind of high bracketing that. So let's look at building permits within the state of Texas. Same thing you saw on the national level, you've seen on the local level. There's single family, there's your multifamily. We've dropped down again. We continue to build and increase more and more since the recession. Still not staying up with what the population growth is. Population in Texas is just very consistently growing. It's going to continue to grow that way. It's about a 2% growth rate of population for Texas. You look at this, that's 3.7 million barrels per day in production that we do in Texas. That puts us the number 7 producing entity in the world. So Russia, the United States total is around 10 million barrels of oil. We're a third of that, or a little more than a third of that of the production. So we're not part of an OPEC cartel. So the free market just continues to produce as much as they can whenever the price is at a place where it is, and their ability to produce that at a break-even price. That break-even price has continued to drop dramatically for all the shale oils. So everyone thought that we had to have $50 or $60 or even $70 a barrel to be able to profitably produce oil. It turns out that's not true. $40 is quite fine to be able to generate a lot of profitable production. So where it is now is beginning to stimulate a lot more drilling and a lot more production. Let's look at Austin. Anyone want to guess what this is? Look at it real carefully. Tell me what you think it is.
All the crazy people leaving?
Yep. You got little drones coming off of this.
No, was that it? Was on delivery?
This is a patent application from Amazon for absolutely. I took it out of the patent office. It's a patent application for no, not even just a drone delivery, a floating fulfillment center. So these fulfillment centers that build like in San Marcos and everything else. Well, this is a high altitude fulfillment center so that they can reduce the time it takes to deliver something to you even more. The reason I put this up here is that is an actual patent application. They are this crazy. They are completely committed to reducing the time and reducing the cost, whatever it takes. Here's what Amazon's involved in. We know this right here, their e-commerce and retail. They're getting into so many other areas. You know some about the media and publishing. They're the largest cloud provider for being able to provide an infrastructure in cloud so you can just run your whole company and just move it over to Amazon and let them run it. They're the largest provider in the world for that. They're getting into banking. They're getting obviously into grocery business. They're getting into transportation and logistics. They're getting into They've bought robotics companies to build out all the robots to be able to run their fulfillment centers. They're leasing airplanes. They're building airports. The size of this organization and their expectations for how much kind of growth they're going to have are staggering. So when we talk about Amazon for any city, you have to realize you're talking about a company that is moving at a pace that really no one's ever seen before. Here's the requirements for what they want. They want a population of 1 million or more. They want a stable business environment. They want to be able to attract tech talent. They need to be able to have a lot of land for them to be able to build everything on. Their first phase is 500,000 square feet. By 2019, it's probably really 1 million. So you have to start kind of getting your head wrapped around all of that. And you're really talking about more than 50,000 people in the first 10 to 15 years, because they have an immediate impact of almost one additional person that gets hired. That's what they are in Seattle. They have 40,000 people hired in Seattle. They have another 50,000 people that are directly hired from other companies to support them. And the real factor is probably another 100,000 in addition to that. So you're probably talking somewhere closer to 200,000 impact of that company coming to a city. But right off the bat, you got to have 50,000 people, and a lot of them are the tech workers. Not all of them. It is the headquarters. So you're looking at we're creating jobs here around 25 to 30,000 a year. And you're going to be adding another 7,000 to 10,000 jobs a year in addition to that 25 or 30,000. That's a big, tall order. Plus, you're going to have to be creating, in addition to the housing that we already are not creating, you've got to start creating another 3,000 to 4,500 homes in addition to be able to stay up with what Amazon's needs are going to be. So it's a big, tall order for that. Here are the Austin positives: culture, tech, labor force, a lot of higher education, technical training, very good. Affordable housing is actually a tremendous benefit compared to the other markets. Even traffic is an advantage compared to some of the other markets. If you look at some of the markets they're looking at, take Atlanta, take Boston. Anyone been to Boston lately? Driven around there? You will see some real serious traffic jams versus what we have. So I live in Georgetown. I've got offices spread all over the three-county area, and I drive to all of them all the time. And we really don't have traffic compared to what some other people do. The challenges are that they need an airport that has got more direct flights than we have. They need a labor pool that's probably bigger than what we have. We're not really high up on the mass transit options. Real big challenge that they need to have a place that's already got the piece of land, it's already got the entitlements, ready to go, so they can go build their first $1 million square feet of their 8 million square feet. Those are all kind of big challenges. Kind of give you an idea, here's the type size of companies we have in this market right here. HEB, those employees are spread out over many, many different buildings and places and locations. Dell's kind of in one basic campus, that's only 12,000. Now you're talking about 50,000 to 100,000. Apple and IBM will be the only similar type campuses, and they're only at 6,000. So you're talking about a tremendous impact on a market. Austin's got the highest percentage tech labor of any of the cities that were listed, almost any city in the United States. But that only gives us 113,000 employee-based tech jobs to pull from. And we would need to hire 50,000, of which some percentage of that, probably 70% of it is tech workers. So I think that would...
2% of those people don't have jobs right now.
Yeah, and they're not the ones you want to hire probably on the tech world. If you're a tech worker right now, you don't have a job, a little red flag kind of lurks over your head, like, really? So you look at Boston, it's 10%, but they've got 264,000. Here is probably the leading candidate, the Washington, D.C. area. I mean, they actually had 3 different cities they listed on their 2020 short list, and they were within 50 miles of each other, cities or areas. And that area's got 300, they got 3 times the tech workers, and it's on the East Coast for a time zone, and it's near the center of power, and it's got good airports. So that'd probably be my candidate for the leading candidate. Here's notwithstanding that, here's what everyone ranks us at. I even put a Irish betting site up here, which has actually been quoted in the Wall Street Journal several times. But you see how many times Austin is listed even as number 1. Here's GeekWire. They had a good analysis showing that their number 1, 2, and 3 categories were listed with the Washington D.C. area. My grouping, my bet would be Washington D.C. would be number one, probably Atlanta would be number two. Dallas is not even listed up here except over here, and I'd put Dallas at number three, way ahead of us.
It's only a Dallas firm.
And this is a Dallas firm that put this together, and their comment was that only cities over 4 million population even have a chance of being able to handle this, and I actually agree with that. I think it would crush us. We would never relocate another company here for the next 2 decades if we were to land Amazon. I'd rather see them go to Dallas than anyone coming to Texas would not go to Dallas. They'd come to Austin. For the smaller firms, we have a more diverse network, so that makes a whole lot more sense to me. But Jeff has not called me up to ask me what my opinion is, although
Maybe
it's
you should put a comment.
interesting how many places still contain. Brookings is a very good, reputable environment. Business Insider is very good analysis. They rank us number 3. I don't get Boston at all. Yes, there's a lot of education, but my goodness, the cost of living and the traffic would be really challenging. So that's kind of, everyone always asks about Amazon. There was all my comments. If you want to look at where you're going to be in Austin, I think the best measure is some kind of measure of economic growth, not just jobs, but how our company's doing, what's the economic health of the area, and over a long period of time. So if you look at over the last 5 years and you look at all the metro areas, Austin comes in number 2 for what's called the gross regional product, like the GDP, GRP, for its growth over the last 5 years. Number 2 behind San Jose, ahead of San Francisco, ahead of Dallas, ahead of even Seattle, in spite of all their growth they've had. So that's about as good as it gets. That's from Bureau of Economic Analysis, a very reputable group. So I think that says pretty much everything I need to say as far as what are you going to be seeing for Austin. We have so many things that are hitting on all cylinders. The last 12 months, we grew jobs at a rate of 2.9%, which is the 6th best in the United States. There's the 30,000 jobs I was talking about. Some of these markets in 18 months ago were growing at 4 to 4.5%, and our unemployment rate has dropped so low it's just hard to be able to grow at that level. We had this time last year, and go back as much as 18 months, probably had 4 or 5 different markets that were at 4% or more growth rate. No one's at 4% growth rate anymore. The reason is because you can't hire them fast enough. They're just not the employee base there to be able to hire. So we could grow more than this. We could be in the 35,000 range, 38,000 range, which would put us up to number 3. But we're suffering from the same things everybody else is. Our unemployment rate's so low, we really don't have the qualified candidates to be able to put in there. That's a pretty beautiful graph. And that's your growth of payroll from starting at the recession around 775,000. We're now above 1 million in employee payroll. That's a pretty white hot, pretty amazing. You saw it flatten off this last year, the last 6 months of this year. You saw it kind of flatten off, seasonally adjusted, and actually drop from some months over what it was. And that was, again, all because of our unemployment rate had gotten so low. But even in spite of that, you see what's happened the last several months. Let me just give you a little picture of what our workforce looks like. We're rated very highly for share of bachelor's degrees. Our workforce got about 42%, 43% have a bachelor's degree. There's only, 5 or 6 more, 7 other cities that are more than that. There's really 3 that fall in one category: San Francisco, DC, and the San Jose area have got a pretty high percentage. And then you drop down to this other group. If our ability to turn out and import in BA degree and master's degrees and PhD degrees continues to improve like it has, we've gone up in our rankings, then that would be the single greatest thing we could have as far as solidifying our job environment. And look at this. 72% of the jobs created since the last 6 years, 72% of those jobs went to someone with a BA degree. So that tells you a lot of where job growth is going to happen. It's going to happen where there's an educated workforce. All these slides, Amanda's going to send you all these slides after this. I'm sorry. I'm sorry everyone taking pictures of it. You're welcome to, but you also will get the whole slide deck. This is a great index. This is from Cushman Wakefield. They looked at startups, how healthy they were, how long it took them to get profitable, how long it took them to reach their goals, how much fundings they have, what their their whole health of the entrepreneur startups were. And as you looked at that and then created and they came up with a bunch of factors for it, created an index for it, we wind up being the number 2 index for that, and the number 2 city. That's a really strong indicator, something that really bodes well. Companies like Amazon, that's what they want to see. They care about that as much as they care about the tech. It's not just about having a tech labor force, but how fast are you growing that tech labor force? There's markets by percentage of tech workers. The number I showed you was 12%. The numbers I've always seen at 12% puts it up there. This was a report that just came out just recently. They had us down to below 10%. I know that number's not right, but it's a little more than that. But you get the drift. We're ranked up there in the top 4 or 5 as far as percentage of tech workers. If you look at how fast we've been creating jobs over the last 5 years, in these 4 major areas, which are where you kind of lump tech workers into, we're ranked 3rd as far as growing workers the fastest. We'll finish up with real estate and kind of where everything is with real estate. We can look down here at Williamson County. Overall, the Austin area grew 2.3%. Your median home price grew 4.9%. You're at 289,000 now. Total number of homes sold were 10,000. I had so many agents talk to me about how last year just wasn't as good as 2016. And it's like, actually, it was. We sold more homes in 2017 than we did in 2016. They definitely some other factors involved. We have price point issues. We have growth in different areas. But notwithstanding that, you still grew in Williamson County 4.9% more 3.5% more transactions. In Travis County, it was definitely, it was only as good as 2016, which was a really good year. Things were great for everyone in that year. Your days on market have definitely increased, the number of days. I'm going to show you, I'm going to have another look at that. Active listings, a dramatic drop in active listings across the board. That was kind of the big news flash last year was January 2016, the number of active listings available dropped by probably 2,000 average per month. Every time you went into the MLS, you had about 2,000 listings, fewer listings. And that pretty much held, it kind of started right in January and it held true the whole year, just about, of where you were with active listings. It'll be interesting to see where that is this next year. Is it going to be equal to 2017? Will you start adding some more listings back into it? I think it's going to be a challenge. And I've already looked at all that. Let's look at days on market. This is my last slide. So if you look at where you're in December of this year compared to last year for December, you see the number of days on market that were added, so 11 days on the market. If you just take the average for 2017 and compared it to the end of the year, 2017, December, you added 19 days. So some pretty big changes for how many days on market. Still a very healthy market. It still is better than what is termed a balanced market for 6 months as a balanced market. It's just different. So, all right, we kind of got to the end. Any questions? I went pretty fast because I want to get you all out of here on time.
That was good.
Does anyone have any questions for him?
How do we get the email of this?
I will, Amanda's going to send it to me, I'll get it back to all.
Okay.
That's her name, Amanda.
Thank you so much.
You're welcome to cut and paste out of there. Everything is sourced on there. You can see where the sources are. If you have any questions about the sources or have any questions about it doesn't make sense to you, just drop me an email. I'll be happy to give you more than you want. Said one more question? You have some?
No.
Okay, thank you all very much.